Welcome back. Apollo Hospitals is the stock which is on our radar. The stock is open with a cut of 2%. It's a mixed set of earnings this time. The revenue growth was largely in line with expectations, but there was a disappointment on the margins, which slipped on a sequential basis and on a year-on-year basis. Sunita Reddy, the MD of Apollo Hospitals, is now with us on the show. Ms. Reddy, morning. This is Rima here. My first question is on the digital business, the Apollo 24/7, which has reported a big EBIT loss of 140 crore. Could you walk us through what is your expectation of cash burn for the digital business and how long will it last, sustain?
So the digital business actually did well. They grew by 21%. So the GMV of the digital business was at 117 crores last quarter. Quarter on quarter, they grew by 21%, and they were at 125 crores. More importantly, they're on track to achieve a GMV of 1,500 crores, which is really ahead of their AOP. And I think you spoke about margins earlier. I have to correct you on that figure because it's completely wrong. Our margins grew 365 basis points in the healthcare services business. So there was a very strong growth in margins. About 90% growth in margins and 7% growth in revenue quarter on quarter. Healthcare services came in at 2,023 crores of revenue. Pharmacy was at 1,148 crores of revenue. And only in AHLL, where the COVID diagnostics came down, we were at 293 crores of revenue. But all in all, we actually... go ahead.
Thanks for that, ma'am. Good morning, Prashant here. I think what Rima was talking about was overall margins, which came in at 12.9%, right? So there is. Could you just talk to us about what happened? I think overheads went up some 20% plus. Just some outlook in terms of where margins, you see margins going this year, will help.
See, Apollo Hospital has three engines of growth. The largest, of course, is the healthcare services, where we're improving dramatically. In the healthcare services alone, we registered a profit of 222 crores. With 60% occupancy, we're able to do that. We believe that we have a headroom for growth. By moving to 70% occupancy over the next 15 months, we will actually grow EBITDA by over 30%. So that is healthcare services. If you look at Apollo Pharmacy, they had a growth of 9%, of 20% quarter on quarter. They came in with a revenue of 1,148 crores, but the expenses because of the launch of digital was at 134 crores, slightly ahead of our estimate, but the GMV was also ahead of our estimate. And we do believe that this is the future engine of growth. So we're prepared to deal with these losses. These losses have brought down the EBITDA margin, but on the whole, healthcare services EBITDA margin went up by 365 basis points. And this is really, this is 70% of our revenue is coming from healthcare services. So therefore, it is a very important vertical that is driving revenues and margins.
The overarching theme in the hospital space now going forward would be the influx of medical tourists coming in from abroad now that things are opening up. What are your thoughts on that? Typically, what pre-COVID proportion of your revenues would come from that, and going forward, do you think that will increase?
Yes, certainly. I think that was a very good question. It will certainly increase. We did not see much in the first quarter because our northern region did very well because international patients came back. But in the south, the traffic is still to start. We suppose more flights are expected to happen. And with that, we think that at least we'll close this year with about 12% of revenues coming from international patients at premium pricing.
Are international patient volumes, ma'am, back above pre-COVID levels or back at pre-COVID levels?
They're slightly below pre-COVID right now because all the flights have not resumed.
So pre-COVID, you would do what? This year you're guiding for 12%. Pre-COVID, that number would typically be how much?
It would be 15% in the metros, but blended again at 12%.
Ms. Reddy, coming to the hospital business where there has been a good margin improvement, could you tell us what were the occupancies and the average revenue per occupied bed and how would it compare?
So the occupancies were at 60%, but we don't really measure occupancies. We measure registrations, and our registrations went up by 9%. And the reason why we're not looking at the occupancy is that we're very focused on asset utilization. So our average length of stay actually came down to 3.6, which is a 25% improvement over last year. And with this, the asset utilization went up. ARPOB was at 51,500 rupees. And again, a growth of over 48,000, which was last quarter. And this is without doctor's fees. So if you add doctor's fees, it was at around 61,000 was our ARPOB.
Ma'am, can I hold you for some guidance on the overall margins? I mean, if you will, for FY23. I mean, some idea to think about it.
I think first it's important to think of it as three separate businesses because there are three engines of growth.
Yeah.
And one clearly, if you look at 24/7, it's not only going to earn revenue, but it's going to funnel patients into the Apollo system. So if you look at the Apollo margins, we're at 24.9, which is, like I said, a huge improvement over last quarter. If you look at mature hospitals, we're at 27% EBITDA margin. So we truly believe that this 24%, 24.9, will move to 26 to 27%. And we will definitely achieve that over the next 15 months because we have that headroom for growth. And that's what's important. Apollo added 2,500 beds. So we have a mature cluster and a new cluster. And with the occupancy improving in the new cluster and the mature, the EBITDA will go up by 25%. Margin will move from 24% to 27%. This will be benefited by two levers. One of them is case mix. The second is cost, rationalization of cost, which will add another 100 basis.
Well, that's pretty clear then. 25% goes to 26, 27% over the next 15 months or so. You spoke about Apollo 24/7 being, a driver for patients as well, a funnel, etc. But from a stock market standpoint, it's also likely to be a driver for valuations. And this is a question that we've been asking you for time and again. And I see that smirk on your face as I do that again. You said that you are looking at valuations of $2.5 billion for this. By the end of this calendar year, you are likely to close in. There is investor interest. But at the same time, there is a fair amount of competition in this space as well. What would buckle first? I mean, would you continue to delay it until you get the valuation of your choice? Or would you, get a lower valuation if you get the investor of your choice? And by when?
I think, what you said earlier, at least 2.5 billion for the current business is something that we will get. You must understand that in this business, we're actually the fastest growing. We launched it only 2 years ago. We've had 17 million downloads as opposed to 14 million in the last quarter. So it is the fastest growing digital business in the healthcare space today. And we will soon be number 2. I'm sure that funding is not a problem. Like I said, in December, we will announce the funding. And I think we're on track. In fact, our performance has been way ahead of our AOP.
And the valuations by December end, considering the growth that it's been seeing, should be in excess of $2.5 billion?
Well, let me not get too optimistic on television, but you will hear it soon.
You also acquired a hospital, ma'am, in Haryana recently for 450 crore, which marks your entry into Haryana. Could you tell us how will it be funded? What's the growth outlook? Would you look at expanding a little bit more?
Yes, we are looking at expansions in the north. Haryana was just our first. We will add, we're looking at 2 other assets that we will add. Growth will be funded by internal accruals. Currently, we had, as of June 31st, we had 900 crores in the bank. Free cash flow expected this year of another 900 crores. And 24 months later, when the second part of the Apollo Healthco transaction is completed, we will get an additional 1,200 crores. So clearly, we have around 3,000 crores that we can use for expansion. Expansion will be mostly focused in the north and the west.
We presume that the 1 billion target that you have with Amazon stays on, right?
Pardon?
The $1 billion target that you have with Amazon by year 3.
So Amazon, we've just the technical part of the collaboration has been completed. Amazon is now opening dark stores. We have 16 dark stores ready for launch this month, and with that, the GMV of Apollo of the 24/7 digital business should grow.
Take that point. Thanks a lot. Always a pleasure speaking with you, ma'am. That's the management of Apollo Hospital guiding that margins would improve to around 26 to 27% over the next 15 months or so. Looking good for a couple of these metal stocks. We have Tata Steel, which has moved to the high point of trade. The metals index actually has moved to the high point of trade. And the other component that is aiding the index is Reliance. So that's the other stock which has moved again to the high point. Mitesh Chakkar is back with us. Mitesh, what do you make of the opening? I mean, nothing sort of opening if you look at just a point to point, but beneath the surface, a couple of sectors and stocks are moving high.
So, Mangalam, nothing sort of opening after a good rally is not a bad news exactly. I think a lot of people are liking that. And you were just highlighting metals. I think, what is happening is that with the index kind of getting heavier and extremely overbought, I think as I've been maintaining for the last 2-3 days, the trading opportunity lies more in identifying stocks which are giving a breakout. You just mentioned one of my calls, that's Tata Steel. Disclaimer, we have some covered call positions over here, but that's given a good breakout above 110. So that's a buy with a stop below 109.8 for targets of around 116.5 to begin with. And I eventually suspect 120, 119, 120 is the range which I'm looking for the stock to hit. The other stock is Naukri or Info Edge. That's also given a good breakout. So that's a buy. Keep the stop loss just below day's low of around 44.30. So 44.25 would be a good stop loss. And 46.75 on the upside is the near-term target.
Thank you very much for that. Another big mover today is Bharat Forge. It came out with numbers yesterday, but the stock has surged 5.5% today. The revenue growth for Bharat Forge at 28% was very strong, much ahead of consensus expectations. But let's shift our attention now to the commodity markets. Manisha is here with us. Manisha, what is the one commodity that you're tracking?
Well, thank you for that. I'm sticking with metals as well. That really seems to be turning out bright. And I'm looking at copper prices for one, which is trading at a 6-week highs. And we have seen prices gain up by 4% in this week. The prices also are up nearly 12% in the last 1 month as well. The gains come in as the markets are looking at funds looking at higher data here. The net shorts are just about 24% of the open interest right now. And the market's also looking at the US climate deal. That would mean more metal buying as we move towards energy efficiency. If you look at the Shanghai inventories, those have continued to decline as well, 79% down since the month of March, and the LME inventories have been declining too. The kind of discount that we were dealing with earlier seems to be turning into a premium, so that tells you that on-ground demand is strong. There is also power rationing in China's Zhejiang province, and that also has led to some production and smelting in case of many of those metal prices. That is what the prices have done until now. We are 18% higher from the 20-month lows of $6,900 that we were trading in the month of July. Though from the kind of highs that we have seen, all-time highs at around 10,845, we are still 25% down from those kind of record highs in the market. The support also comes in from the production cuts that have come in from across major producers there. Codelco has suspended mine construction projects, and they say that the guidance for this year is expected to be lower year-on-year basis. Not just Codelco, Vale SA also has said that they have slashed production for this year. We also have Antofagasta saying that the copper mine output declined 6.5% in second quarter, and they are looking at a negative number for the third quarter as well. The global production is something that has been increasing as well. 2020 clearly was a negative year, but last year was up by 2.8%, and this year with a gain of 2.9%, we are looking at a global copper production of 21.84 million tons. The consumption should come in on your screens as well, and that number also shows quite positive. Last year was 24.4 million tons. This time around, even with what China is going through, 25.1 million tons of a demand estimation is what markets are working with, and is the reason you have seen the copper prices turn positive.
Manisha, thank you very much for that. Let's move on. Glenmark Pharma is the next company that we're looking at post the Q1 numbers. Revenues and margins came in below estimates. The India growth was strong at 17% sequentially. The US business was weaker than expected this time around. VS Money, the executive director and the global CFO of Glenmark Pharma, is with us, and my colleague Ekta Batra is also will be joining in. Ekta, over to you.
Hi, Rima. Thanks for that. Well, yes, Mr. Money, I wanted to start with the margin picture because that came in at around 15%. Estimates were at least around 17% this quarter. Give us a sense in terms of what exactly the US price pressure looked like. Did that weigh on margins? And the input cost, because we just heard the management of Aurobindo on their conference call indicate that there is some amount of softness which has come through.
Sure. So I'll take this in a couple of parts. So first and foremost, our margins, while it came at about 15.5%, and we also gave a guidance to the street that there was this COVID drugs write down of about 40 odd crores. And if you had to, take that one-off out, we would still be at about 17%. So all in all, I think it was a reasonable quarter considering some of the challenges. Also, in terms of, for the full year, we still feel that last 2 years we've been at about 19%. We should be pretty close to those numbers. And this overall, in terms of the pressures on the input costs, they are there because of short-term issues and some of the geopolitical issues. But during the year, obviously, we hope some of these taper off. Assuming those things happen, we should see our margins pretty close to what we are trying to indicate. Okay. And as far as the US market goes, obviously, depending on the portfolio, everybody have got some kind of price pressures. And normally it's at about high single digits. But this quarter also there were, because of some of the supply chain disruptions as well as some geopolitical issues. Obviously, I think going forward we should be able to kind of do a better job in terms of getting our sales up.
Okay, so you're sticking by that exit run rate for FY23 in terms of margins, similar to what you did in FY22, around 18 to 19%. $86 million is what you generated in terms of sales from North America. Give us a quarterly run rate going forward, because the street was anticipating at least around $95 to $100 million. So what are we anticipating for the next couple of quarters?
So that's my sort of response to that, is that obviously there was, and obviously price pressures are always there, but also there were some supply chain distributions, as I said, due to basically the overall geopolitical situation, as well as some other challenges in terms of logistics, etc. So obviously those weighed down on that. We are hoping to end the year at very close at the flat growth or a small single-digit growth compared to last year. So, that's how we look at it. And we have 10 to 12 launches coming up during the course of this year. So I think all this should help us to reach at least where we closed last year.
Okay. India has grown around 17% Q on Q. Your consumer segment has also done quite well. Give us a sense in terms of where exactly India is headed. What is the kind of, opportunity that you see, especially even in chronic segments such as diabetes?
Yeah. So, India has been doing well for us for quite some time. We've been among the fastest growing company over the years, and that's why we improved our ranks. So if I were to look at India, obviously last year in the first quarter, there was a large bunch of COVID sales. But net of that, even in July, if you look at it, as per AWACS, our growth is almost 16%, and at IQVIA, we're about 10%. So we see the year, at a strong growth of about mid-teens, happening during the year. So India is really a good thing that's happening. And across segments, we improved our ranking also. If you look at our cardiac, we used to be at about 6th. We have now reached 5th. Okay, so therefore we are improving on that segment. Derma, we continue to remain at 2nd. So some of these we have done quite well. And obviously on the consumer care sector, there have been a number of good product launches also. So those have helped us to actually do well. This quarter was really very high growth, but we continue to hope that the growth can be sustained, or we hope to have a good growth in the quarters going forward.
Okay, you did have a out-licensing agreement just a couple of months back. You are still guiding for 1 to 2 in FY23. Where does that stand? Because that always is, a little difficult to assess that whether or not that's eventually going to go through because of how, successful the molecule or the NCE is. So currently, where do you stand in terms of the 1 to 2 licensing agreements which you've guided for?
You're absolutely right. This is something difficult to assess. Obviously, we are having a number of data points coming out on some of the key targets that we're working on, especially 1342, 1442. So I think we are hoping that by the end of this year, before the end of this year, we should have at least one deal done. Okay, so we're still very optimistic about that.
What's your thought on your balance sheet, Mr. Money? You know, almost 3,800 crores of debt. You had indicated earlier in the past that free cash flow generation has been your priority for FY23. So this year, what's the kind of FCF generation that you target? And by the end of this year, where would your debt stand at?
So first, I would like to address this. So in the first quarter, we ended the debt at about 3,765. And this broadly went up largely on account of basically the currency move. Okay, so rupee moved up from 75.50 to almost 78.5. So that's the reason. Also in this quarter, we had refinanced some of our FCCBs. Okay, so obviously while we had accrued the premiums over the years, there was a one-time big number that we paid off in this quarter. So I think going forward in this year, we should definitely see a decent reduction in our debt. Would not like to put a number to that, but I think it should be decent. Okay, we hope that. That's what we're working towards.
Okay, Ichnos, you had guided that maybe there's a possibility that you could, have some kind of strategic sale, some kind of fundraising on the cards. That was maybe around 2 years ago. Where does that stand? Is that still a plan which is on the cards?
For Ichnos, definitely. So obviously, we are waiting for these data points to come out. If we could do a licensing deal as well as some of these data points come in, then there is definitely a good opportunity to do a strategic, kind of something that will help us to kind of capital raise out there. And that's been our endeavor.
Okay, just a quick last.
If you can recollect, last year in one of our other subsidiaries, we were pretty successful as far as GLS went. Yeah. We did a IPO and that was okay. So I think going forward in Ichnos also, we're hoping that these data points come out well and we're able to do a licensing deal. And on the back of that, we should be able to kind of do a capital raise.
Okay, I just had one quick last question, Mr. Money. What is the possibility of revising this guidance on the upward for your revenue growth? 6 to 8% is what you're assuming. You did stick to your FY22 guidance of double-digit growth. But 6 to 8%, can we expect a revision on the upside at any point through the year?
I would definitely be conservative and also see, while the first quarter we had it's a negative 6%, but there were a lot of COVID sales last year, as you are aware. And net of that, what we have guided is that it was a 10% growth. So we would say in the next 3 quarters, if we grow on these levels, we should be able to get to 6 to 8%. And we'll currently hold on to that number.
Mr. Money, just on the US pricing scenario, we did hear Aurobindo also indicate that this quarter was in fact better and last quarter was quite severe for most companies when it came to US pricing pressure. You have indicated that it was tough for you this quarter. In terms of what you are seeing in the US as of now, when it comes to price pressure, what can you guide for? What is the industry facing? Are companies still exiting products which are unprofitable?
So I think, it's a very good question. So obviously the portfolio plays a big role in this. So even when we look at the pricing pressures, whatever, it is a portfolio that plays. So for us in this quarter, as I said earlier, it was a higher single-digit price pressures, and most of the competitors feel the same. Okay, the peer segments all feel the same. And as far as the year goes by, because of 10 to 12 further launches that may come during the course of the year, I mean, we hoping that the price pressures will always be there. At least we'll be able to kind of get a single-digit growth compared to last year, or at best, or at least do a flat sales, compared to last year.
Mr. Money, thank you very much for joining in, and thank you, Ekta, for guiding us and helping us through this interview. For the markets, it's absolutely flat on the benchmark indices. The mid-caps are outperforming. The mid-cap index is a gain of close to about 0.5%. Tata Chemicals is clearly going to go down as the stock of the week. It had a big up move on Wednesday, went flat yesterday, but today it's rallied close to about 5.5% on good volumes. IGL has added nearly 18% in the last 3 days. So for the last 3 days, IGL has been rising on very large volumes, and that's clearly one of the big movers. SAIL, Tata Steel, as Mangalam was pointing out, metals are having a pretty good run in trade. Cummins, where the management earlier alluded that at least in terms of exports, there is no slowdown. The demand continues to be broad-based and robust, so allaying some of the investor concerns over there. Info Edge has gained 2% ahead of its earnings, which come out later today. And on the losing side, we will talk a little bit more about Ipca and the guidance cut there on revenues and margins. But Divi's Laboratories has slipped ahead of its earnings today. And keep your eye on AU Small Finance Bank. There was a big block deal which took place. About 80 lakh shares changed hands. 1.3% of the equity. AU Small Finance has slumped on the supply pressure today. Get into a break. On that note, we'll come back and track some other important stocks for you.
Welcome back. There's a party going on in the mid-cap end of things. Even as the frontline indices are absolutely flat, the mid-cap index is up almost 0.75% with nearly 2 stocks in the green for 1 in the red. Chennai Petro has moved to the high point of trade with a gain of almost 11%. While most stocks are gaining, one which is losing big is Ipca Laboratories, down almost 9%. And we speak about pharmaceutical stocks. Ekta's with us. Ekta, Ipca Laboratories, just a line on that. And Aurobindo conference call, you were listening into it.
Well, yes, for Ipca Labs, there's been a guidance cut which has come in on the revenue as well as in the EBITDA. For the EBITDA, they're now anticipating around 21% in terms of margins versus 22 to 23%. And for the revenue growth, they're now guiding for 8 to 9% versus 11 to 12% earlier. That's because the API business is expected to be sluggish. That's on Ipca Labs. You can see that the stock is down 8 to 9%. But Aurobindo is the other one which I'm tracking because their conference call just got over around 30 minutes ago. They have indicated that, US price pressure has settled this quarter. The company has seen input costs soften. In fact, they will see input costs settling and the impact of it in coming quarters. So that should probably aid margins, according to analysts. They will look at acquisitions in India to grow and have begun working on the PLI scheme. They were shortlisted for some products under the PLI scheme, and that continues to be an opportunity. PLI should begin contributing probably by FY23 and FY24 onwards. As of now, not considering a buyback, and the UGA sale, if in case there is something material, they will obviously inform shareholders. But as of now, it's probably not on the cards. When it comes to the injectables business or the complex generics business. That is an important trigger that the street has been watching. Remember, the stock has corrected so significantly that the street doesn't seem to be perturbed by these statements at all, that injectable sale business is probably not going to happen for the next couple of months.